The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.
Welcome to Honest Money. I'm Warren Ingram.
This is Pieter Villiers.
This is the third in our series on investment vehicles. And in the first two episodes, we covered, in the first episode, we covered retirement funds. And in the second episode, we covered tax-free savings accounts. So this, it's kind of an interesting name because it's what we would call discretionary vehicles. And I'm going to let Pieter get into a little bit more explanation around that. But just in general, it's the thing that most of us would want, where we want to buy our own share or our own unit trust or something where there's not a lot of rules, not a lot of restrictions around it from a government point of view or something like that. And generally will be money that we've paid tax on, we're now investing it. So for most people, I mean, I don't know what you did, but like for me as a youngster, when I started out and I wanted to buy my very first share, which was a tragic mistake, but I did it anyway. That first share that I bought that would be called a discretionary investment. The discretion was mine to decide what to buy, mine to decide when to sell it, and I sold it far too late, in all honesty. But there were no rules around that. It was just something I could do.
Yes, it's fully flexible, so there's no limits, there's no regulation constraints. You can put as much in as you want, you can take as much out as you want, full flexibility. So if we go back to the explanation around taxation for retirement funds, idea behind that is government wants us to provide for the future. So they incentivize us now to save for retirement. They give us tax benefits. But we know with a retirement annuity that we covered in the first episode, our money is locked in for the longest period. So we get the most tax benefits on that. Tax savings account is second. So our money is not locked in. It is more flexible. So there are still a lot of tax benefits, not as many as a retirement annuity, but it still incentivizes us to save for long term. Now, if we get to discretionary funds, because it's so fully flexible, you can put in as much as you want, you can take out as often as you want. There's no like long-term incentive really to keep it invested. So there's also no tax benefit. So now with a discretionary fund, it's fully taxable. So you pay interest tax, local dividends tax, local offshore, capital gains taxes. It's also estate dutiable. So all the taxes apply. With each one of those tax segments, there's an interest exemption and there's a capital gains exclusion that we can apply, and all of that. We don't going to get too deep into the taxation of it, but just know it's fully flexible, fully taxable. So it's nice to use those investments, I would say, for your short, medium-term goals, even sometimes long-term goals. So let's say, I'm building up an emergency fund. I can either keep it in the bank savings account or I can put it in a money market fund. That's a discretionary fund. I'm saving up for a car deposit in 3 years or a house deposit in 5 years. I don't want to use my tax-free savings account for that, which you shouldn't. Can't use your RA for that. Right, so I'm using it in a fully taxable investment. It's fine, I'll pay a bit of taxes when I cash it out. It's okay because I want that flexibility. And yes, you can still invest in ETFs and unit trusts, but you can also now go and buy your individual stocks. If you're using platforms like, let's say, in Easy Equities, you can use the Easy Equities ZAR account, they call it. That's the local South African version. You get the Easy Equities USD account that's now buying US stocks. So South Africa, you can go buy your Villiers and your Pick n Pay and your Naspers. On the US side, you can now go and buy your Teslas, your Apple. That is now in a discretionary fund. So we use that. It complements a portfolio. We'll get to the fourth episode. So the next one, we're going to kind of show you where that really fits into the overall picture. But it's very easy to understand. There's not really a lot of rules around it. It's at your discretion how much you want to put in. Sometimes it's called the linked investment. They have different names. Sometimes it's called the fully taxable investment. It's tomatoes. It's the same thing. It just know that it's fully flexible and you can use it for your short to medium term savings. Sometimes also long term savings if you want to bolster your retirement provision and maybe you've maxed out both your RA and your tax-free savings account, then this could be a good option. Sometimes if you take money offshore, directly offshore, and you want to invest it outside of South Africa in hard currency, that's also a discretionary investment. Yeah. And that brings a lot of liquidity for you in retirement, which I think is actually also very important.
I mean, I'm not going to steal the thunder of the last episode, but for me, that's really where a lot of value lies in these discretionary investments is very short term, so your emergency funds, and then very long term where you build up your global allocation. And so those would be the two primary places that I see a lot of people would save or allocate money into discretionary investments. So, and because they're flexible, I guess, I mean, I hate talking about them, but I guess that we would have to throw in the whole world of cryptos would be in there as well.
Yeah.
It's a discretionary way to lose your money. You could do it that way. So those are it's as wide as there are investments available.
Yes.
Which does mean as well that sometimes there's not a lot of regulatory protection. So just understanding that there aren't built-in legal protections, for example, as you would see in a retirement fund where they control the mix of your assets to give you some protection. Here you can, because you can buy almost anything, you could see, depending on what you choose, your money could go up very strongly or you could lose it all. And your choices are wide, which means your opportunities are wide and your risks are as wide. So there's a lot going on there, and tax is a factor in this, but then I guess we need to jump into, there is one kind of discretionary investment where we do get some kind of a tax shelter, and so we need to discuss endowments, I guess.
Yes. So endowments, I would say, is like the baby between a RA, a retirement annuity, and a discretionary fund. So if that's the RA and mom's the discretionary fund, then the baby is the endowment. That's the best way that I can explain it. So it has benefits of both, but it's not the same thing as either. So what does that mean? From a taxation point of view, you save taxes. It's not tax-free. So I have to get a little bit technical here now because it has to understand how the taxation of an endowment works. If you invest in a discretionary fund and you earn interest, let's say it's in the bank savings account, then all right, we know that the first 23,800 Rand is interest tax-free. Above that, if you earn more interest than that, it gets taxed at your marginal tax rate that varies from 18 to 45%. Now, if you are in a high marginal tax bracket, let's say you're in the top income bracket of 45%, you're going to pay almost half of your interest tax to the taxman in a savings account. But within an endowment, they cap you at 30%. So that now becomes powerful for those high income earners to shelter some of that tax, to make it flat 30%.
I mean, that's an important point, right? So if you're a low income taxpayer and you're at 20% on income tax or 25%, you go into the endowment, you're immediately at 30.
Yes.
So you actually lose out.
Yeah. So endowments are for your high income tax earners. Usually doesn't make sense for low income in most cases. Maybe like we can really point out one condition it might make sense, but usually for your high income. So if you're above 30% tax bracket, then usually that will make sense.
And that you believe that you're going to be there for a long period of time.
Yeah. Yes.
I mean, that's the other thing. If you're at 30% now, but you're going to retire and you're going to drop down to 18%, not for you.
Yes. Dividends gets taxed at 20% on both, so that doesn't change. And capital gains taxes, so I'm going to explain how that works. If you sell, let's say you buy a share, let's say ETF for 100,000, you sell it for 200,000, you made 100,000 Rand capital gain. Now we get a 40,000 Rand capital gains tax exclusion that gets deducted for everyone every year. Left with 60,000, 40% of that then gets applied to your marginal tax bracket, and then you pay taxes. Now, I know this is many steps, and I don't want to bore you to death. What that means is if you are in a discretionary fund, let's say you've got your ZAR account, you're buying your ETFs and you sell them, if you're in the top tax bracket at 45%, the maximum capital gains tax rate that you'll pay is 18%, 18. That's how, if we apply 45% times 40%, that's kind of how we got to that number. Within an endowment, they cap that at 12%. So instead of paying 18, you pay 12%. So
and
again,
you always pay 12.
Always pay 12. If you're on the 18% tax bracket, your effective capital gains tax rate would be 7.2%. Now, if you're going to put in an endowment, you pay 12%. So it won't make sense if you're below that 30%. And then estate duty, it's still estate dutiable, but you save on executives fees, because that's now where the second advantage comes in. If you take out an endowment on your life, because it's almost like it falls within an insurance category, it's like a long-term insurance product, actually also an investment. It means like I'm the life assured, primary one, I nominate my wife as a secondary life assured and the secondary policyholder. If I pass away, the money goes into her name and it transfers to her. She becomes the new owner. That amount will still be a estate deductible, but the executor's fees then won't apply. So that 4% effective, if you add the VAT amount of executor's fees, will not be applicable. And if you've got a large portion, even especially if you go overseas, building a massive overseas portfolio of many millions, that 4% can get quite high. So that's a good way to save on executor's fees. But caveat with endowments comes in with anything, as we said, the longer you keep your money tight, the better the tax advantages. So now the government is giving you tax advantages, but also you have to keep it for 5 years. So there's a 5-year restriction period, they call it. In that 5 years, you get one chance to make withdrawal and one chance to do a surrender or loan. Don't have to worry too much about that. But usually if you go the endowment route, you have to be sure that you're not going to use that money in 5 years. And there's another rule that I'm going to talk about is the amount you contribute to an endowment. To make sure that in the second or third subsequent year of contributing, let's say you've got a debit order or lump sums, you should not contribute 20% more than the previous year. I know that I want to get too technical here, but if you do, let's say you put 100,000 Rand in the endowment for 2 years, and then suddenly you put 200,000 Rand in the third year, that 5-year period will reset. So just be cautious of that. If you do contribute to an endowment continuously, you don't want to reset that 5-year period. After that 5-year period has lapsed, then everything has been taxed within the endowment. So whatever you take out is tax-free. So that's good because it's taxed within the fund. So that also kind of creates a tax-free withdrawal, but it's not really tax-free because you have paid tax within the fund. It's just when you take the money out after that 5-year restriction. So it's a great I'd say medium to long-term investing. Personally, something that I would consider for like a education fund for a kid, especially if you're in the high tax brackets. If you say, okay, cool, I've got 2 kids, let's open up 2 endowments, do a calculation, they're going to university in 10 years time, I need to contribute 3,000 Rand per month. Cool stuff, it's 10 years away, so you're not going to need it for the first 5 years. When they hit 18, I can take that money tax-free and then pay for the education on a local side.
I think just to understand about that, so that 5-year period, once it goes through the 5-year period, you're not obliged to take the money out.
Yes.
So the fact is you're allowed to take the money out. And then at that point, you can also decide to say, I'm going to take out 1,000 Rand a month, or I'm going to take out half of the money, or I'm going to take out all. You've got enormous flexibility once it's gone through the 5-year period as to how you access that money and when. And you could say after 5 years, I'm leaving it there and I'm not touching it for another 30 years. And I mean, obviously, that's a great idea because the compounding of that will work in your favor. So I think that it's a very nice way to generate income, for example, for people that are going to be in a very high tax bracket for their whole lives. Because then you can start to blend some of your income from, let's say, your living annuity, which we covered in the first episode, and this, and your tax-free. So it starts to become some kind of a cash flow manager. And the idea there is to optimize the tax that you're going to pay. So you're right, you are going to pay tax, but this is a way of just reducing it. And then maybe just the other point is, if you've got your example, you've put in 100,000 a year and you've done it for a couple of years, and then you've got a much bigger lump sum that you would like to put into endowment. I mean, if you've got them all at one platform, for example, you might find that you should just start a new endowment. Don't worry about adding it to the one you've got, because the fees might be the same. You get a fee benefit at platforms nowadays where you kind of consolidate. So then just start another one. So you've got one that might be 2 years old. Now you've got a new one that's starting now, which means that in time you'll have one maturing in 3 years and then one maturing 2 years later. So you get sort of a sequence of endowments that start to mature. The irony is, for the people like me with gray hair, is endowments used to be the place where you would go in, it would be like your nurses and school teachers would buy these as education plans for their kids. And nowadays, I mean, nurses and teachers don't necessarily earn a lot of money where they're going to be at a 45% income tax bracket. So actually, they would probably be better off just buying a generic unit trust or an exchange-traded fund rather than doing an endowment. So actually, it's become the preserve of those people who have a very high income tax rate. And they would be the very same people who would never have thought about an endowment 10 years ago. And so I think that they are very nice. Just make sure no upfront fees. It's always a red flag for us. So don't pay upfront fee for an endowment, which means if you're seeing that, choose a different one. There's some very good ones out there that, when you buy it from an investment platform, they're not going to charge you a fee. They're not transferable. That's an important point. So if you buy it from a platform, platform A, and 4 years in, and you say, I found platform B's got a better endowment at a lower price, I want to transfer, you can't do that. It has to go, you either have to then do your withdrawals early and all those things, or you let it run for the full 5-year term, then take it out, then not paying additional taxes on the withdrawal.
Yes. Yeah, very important. And one extra benefit of endowment is if you or your spouse is the life assured and it's been keep running for 3 years, it's also protected from creditors. So it's another one adding to retirement funds, protected from creditors. So if you're an entrepreneur, this might also be a nice way to kind of shield from that risk. One of the small benefits that we can add to that. And I think if we go overseas, this also becomes quite important, direct investments offshore. Because if you do see yourself building a big portfolio outside of the borders of South Africa in hard currency, then an offshore endowment can also be opened up. You can also actually say like, okay, cool, well, instead of keeping everything in discretionary funds, I keep it in endowment. Same thing, I nominate my spouse as the secondary life assured, so that money can maintain its hard currency. It can transfer to the next person. You can even nominate your children after that as the tertiary life assured. So if you both pass away, they then inherit that money. So it's a great way to shield your money overseas as well within that wrapper. And the similar rules apply to South Africa as well. So it's kind of the same structure, just in the offshore space. And it's also something that can be used in trusts. You can also, because we know that we had an episode on trust as well, but if income is earned within a trust, in like a savings account, trust is taxed at 45%. It's the highest. But now if you put it in endowment, that gets capped at 3%. So it's sometimes something that can also be considered in a trust if the idea is for it to be long-term, 5+ years of term.
I think, and just to understand, this is not like a scam or a loophole or something. Endowments are very old in our law. I don't know if you know this, it's a benefit of age. Trust, for example, are already 60 years old in South Africa.
Oh.
And the first one was started in 1965. I wasn't even born then. And endowments predate them. So they're very old and well established. SARS likes endowments because they are assured of getting the interest or the income tax and the capital gains tax paid to them directly en masse by the insurance companies. So it's much easier for them to monitor. The cost of collection is low. So this isn't something like where it's a loophole which is going to be closed in a month's time or a year's time. Could be but it's not because it's a loophole.
Yeah.
And then maybe just also on overseas endowments, the thing that catches a lot of people out with their overseas money is that they get so fixated on buying their Berkshire Hathaway shares or their S&P 500 tracker or their global equity or let's say US equity fund. They lose sight of the fact that they're going to pay tax in America if they die. Death taxes. So the moment you wrap it in an endowment, that potential for death taxes is gone. So that's very nice. And also that when you decide to rebalance your portfolio or move from one investment to another within the endowment, you're not exposed to additional capital gains tax in your own hands. All of that is happening inside the fund. Yeah. So the capital gains tax benefit of overseas investments with rebalancing is material, because you've got the foreign exchange impact of all of this as well. And a lot of the time people have sent that money overseas and then they need to make a change. They tweak the portfolio and then they get a nasty shock on a taxable. So it's a very nice vehicle there. And then all the estate benefits that you were talking about are real. Maybe just lastly, that you're not going to get offshore endowment from Vanguard or Fidelity. You're going to get them from companies that have a link to South Africa. Yes. Because they do report to SARS and there is tax payable to SARS. So it's recognized by SARS, but it means that that ultimately the owner or the wrapper of that endowment is a business that's got a South African link. That doesn't mean that all of the investments inside that endowment are going to be to that company. You might get a much wider range. You usually do. But just know that. So if you're looking out and you've suddenly decided that, whatever it is, iShares is your best thing ever, they don't have an endowment. They don't have an offshore. They might have one for UK people in the UK or something. We don't know. This is called Honest Money South Africa, not Honest Money Great Britain. So just know that there is a South African link. And then lastly, I said lastly already, but it's now it is lastly. Be careful of layering of fees. I think you're probably gathering, both Pieter and I like endowments for a specific purpose. What we don't like is when you buy an endowment and then you realize there's an endowment fee which is like 2%, then there's a fund fee which is 2%, and then there's advisor fee of 1%. And before you know it, all of those benefits that you thought you were getting from tax have been destroyed by fees. So do your homework on fees, and don't forget, avoid upfront fees.
Yeah. So some of the endowments are also sold like policy-based retirement annuities, where because it's a 5-year contract and it's under the long-term insurance category, that there's high upfront commissions that can get paid to the advisor, and then those fees are high. Avoid them, please. If you use an advisor, pay them their fair fee for their service on an ongoing basis, whether that is through the amount you've got invested with them or an invoice or whatever means that you decide on. But make sure, as we always say, when someone tries to sell you anything, ask for a proper quote, look at the cost, and yes, any upfront fees usually is not a good idea if it's tied to investment. We're not talking about like setting up a financial plan. Maybe there's a fee for that, but if it's tied into your investment performance and the fee structure, rather avoid that. Just have transparency, full flexibility, and understand what you pay. And yes, I think that wraps up our conversation on discretionary funds. That includes endowments. So first episode, we covered retirement funds. Second one, tax-free savings. Now we covered these two. And now in this next episode, we're going to bring them all together and decide when are we going to choose which one. Because oftentimes I get that question like, okay, I understand all of these, but Pieter, when do I use which, or do I use all of them?
And it feels to me like we've been talking about pieces of a puzzle.
Yes.
Now we're going to look at the picture on the box.
Yeah, exactly.
And how it all works.
Yeah.
And I'm excited because I think we don't always have 100% the same view, you and me. So we're going to learn from each other in the next episode. I do want to thank Sealand for keeping us warm. It's peak winter and I'm feeling good. So thank you for supporting us, Sealand.
Yeah, thank you so much for watching. If you have any questions, please drop them in the comments. Endowments is not something we see a lot of information on the internet. It's kind of like one of those things that you only hear about if you are in a certain kind of income bracket. But if you have more questions on that, please let us know. We always enjoy reading the comments, and it helps us to understand what you guys want and where we can potentially add value. But thanks so much for watching. We'll see you in the next episode.
Take care.
The Honest Money podcast is brought to you by Prescient Investment Management. We consider everything to give you the advantage. It's the future of investing. Prescient Investment Management is an authorized FSP.